Good morning, and thanks so much for tuning in. This is Stocks to Watch on BloombergQuint, and I'm Mathew. In the recent past, you've had so many stocks run up so quickly that perhaps it's getting a little harder to pick the stocks that you need to keep and pick the stocks that you need to buy. Hopefully, the three stocks that we discussed today will help you somewhat in planning your portfolio. My guest today is Anand Tandon. Good morning, and thank you so much for joining me today, Anand. Pleasure as always speaking to you. I want to speak to you about Emami first, and this is the only news-based development that we have among the three stocks that we're talking about. Emami has entered into the home hygiene products segment with the launch of the Emethol brand. And this includes, of course, the whole gamut of home hygiene products. But interesting to note that it's entering the space. And I was reading a report lately, just recently rather, about consumer staples and the fact that they've done reasonably well for themselves in the recent past. How do you rate the company within that basket, and how do you rate the most recent development?
Well, thank you for having me, Alex. So Emami has actually had two problems in the recent past. One was that they were unable to show top line growth, and second was, of course, the fact that the promoters had very high leverage. Now, if you see the last two quarters, especially the last quarter, the top line growth has come back roaring, especially in the health and hygiene segment. And the only segment that has not done so well has been the winter segment, which one expects that as the winter comes in, will actually start to do quite well. There have been a lot of changes they've done in terms of trying to improve their product profile as well as their strategy for marketing, including direct sales, e-commerce, and all of that. So there is something to watch out for. Uh, Clearly, the stock also has run up. I mean, from the fall in after March, it has more than doubled. So it's not as if it is cheap anymore. The other important point, as I mentioned, was the fact that they had heavy leverage, which after the sale of the cement business, which is not, of course, in this company, the promoters have managed to deleverage themselves quite significantly, and that has taken away another kind of overhang on the stock. So overall, as a stock within the sector, it's well positioned. As you mentioned, new entrants, areas that they are entering are really fast growing entrants. Areas, especially given the fact that we have COVID and therefore people are spending a lot more time in home cleaning and making sure that it's disinfected and so on. So all of these have high potential. Now we have to wait for execution to come through. Now, with all that said, the fact is that it is not necessarily the best returning, the best ROE or the best capital managed company. And from that perspective, it is not exactly cheap. It's already trading at maybe around 20 or 30 times 2 years out FY22 earnings, which kind of makes it par for the course. I would argue that from here on, you'd expect to see market performance unless the execution on these new areas is excellent.
Fair enough. Okay, which brings me to the second stock, IndusInd Bank. And this is a stock that was a darling perhaps just about a year and a half back, and that crashed very suddenly and very sharply around the time of INFS and perhaps a little after that as well. The concerns that people raised were with regard to the management change and also the fact that it has a high presence in the commercial vehicle financing space, which was not doing too well. But the stock has now recovered significantly, especially in the last month. It has gained as much as 30%. So you see that upward tick towards the end. It's still over 40% lower than it was a year ago. But should investors or holders of the stock be aware of the kind of movement that is happening right now? Is there anything that justifies that sudden and sharp uptick?
Well, Alex, I think generally banking space has delivered better results than people were expecting. Moratorium, I had personally thought, for example, would lead to a new fresh set of NPAs that has been much more subdued than one expected, and it's going to impact hardly a few basis points in terms of credit costs, or at least that is what it appears. IndusInd in particular had to increase their deposit rates, for example, after we had a problem with the Yes Bank and, as you mentioned, starting with ILFS. And one is now expecting to see, or the management commentary is that from next quarter onwards, they will start reducing the deposit rates. So that's been one of the problems, that the NIM growth has not been as good as it could have been because of the higher deposit growth, and the fact, of course, that they've kind of slowed down their credit disposal. So on the one hand, your top line growth is a little lower, your margins are getting squeezed because of the fact that you are trying to both increase the quality of the credit that you're trying to give out, as well as you're having a higher cost of funds. Much of this will likely get reversed, and I think the market has kind of already anticipated some of that, which is why I would think that the stock price has been going up. So as the fears of a large NPA write-off recede, as the fears that they have one of the higher exposures to Vodafone Idea, as the fear that that will not come a cropper, and as the fact that the NIMs can actually start to increase as deposit rates go down, all of that gives it a bit of the push that we have seen. But the current expectations are that the stock is now trading at again 1.3 times book value FY22. Which is again for the moment path for the course. Now, obviously, as the and you've already moved to almost I think 58% retail book. So your ability to move further down, perhaps at this stage, may not be very high. More importantly, you may not want to do it anymore because I think the corporate sector has shown one of the best performances in the last quarter. So no particular reason to ease off on that. So net, I think we are where we should be again. Not particularly expensive, not particularly cheap. It's unlikely to reach the kind of glory valuations it had in the previous few years, at least for a while. But if they do manage to increase the quality of the portfolio even further from here, given that still have a large auto exposure, then I think you'll still have upside. So again, I think it will no more be an underperformer. But from a purely sectoral point of view, you would still be probably better off going with the leading names in the sector.
Fair point, and that sums up IndusInd Bank very perfectly. Which brings me to the last stock. We're talking about Eicher Motors, and you had commentary from one or motorcycle manufacturer saying that the retail sales in the festive season were good. This is something that a lot of people were anticipating, and perhaps it has panned out that way. But if you look at Eicher Motors, Anand, despite concerns on the supply side over the last several months, which seemingly are being addressed as we speak, the stock has run up over a period of time, and it has gained 8% over the past week. It has gained over 30% in the past month. So it is, in fact, trading higher than all of its simple moving averages, including its 200-day moving average. Is there still room to buy the stock at this point? And how do you see the valuations?
Well, Alex, I think people who buy Eicher are the people who buy the vehicles as well, perhaps, because it's more a brand valuation than the value of that the earnings are going to deliver. So right now, I think the only thing going for the company is really the fact that they are looking at a lot of new launches. The issue, as you mentioned, has been that they've got stuck at something like 70,000, per month kind of production, and they claim that they have almost twice that, or 125,000 kind of order book. Whether that order book is of that nature or not is yet to be seen. But the question is, most of the other players have actually managed to ramp up their production, and Eicher has not, which is a bit disappointing to say the least. The other thing is that while there is a whole new slew of new products that are likely to come through, you also have to realize that the competitive intensity is also increasing. Both Bajaj and Hero now have new launches due next year with Triumph, and of course, in the case of Hero, with the new American tie-up that they have just set up. So overall, I think the higher CC motorcycles will certainly have a lot of competition coming through. And while Eicher has probably the best distribution, best branding, and now with their new do-it-yourself kind of marketing style where you can design your own motorcycle, that's certainly an innovation which the rest of the market has to catch up with. I would still be surprised to see that if they do a kind of market-breaking kind of performance. So
Right.
by and large, most of the places which have the firepower to buy those the Eicher motor vehicles, the market shares are already very high. Those markets where they do not have the pricing power, the capacity to buy because the income levels are lower, is where the market share is low and is likely to remain low. As I said, they just don't have the money to. So I don't know whether there is much upside from here. The kind of premium it's trading at compared to the rest of the sector, again, makes it highly expensive. So a little difficult for it to be a strong outperformer from here on.
Fair enough. Thank you so much, as always, Anand, for joining me this Friday morning. And hopefully you have a very good weekend. Thanks so much for joining me. And to you, dear viewer, thank you so much for joining me as well. There's a lot more to talk about, and you'll find all of that on the website, BloombergQuint.com. So don't go anywhere.